Late last month, the government of China issued $2 billion in dollar-denominated bonds in Saudi Arabia, the first sale of dollar bonds in several years, and the first ever sale in Saudi Arabia. The move received scant attention outside of the international business press, but could mark a fundamental shift in global power. But what exactly does the move mean? Hey everyone, I'm Noah Zerbe. I'm a professor of international relations at California State Polytechnic University Humboldt. Welcome to Global Insights, where we break down global politics and international economics to help you better understand the world around us. So let's start with the basics. In mid-November, the Chinese government announced the sale of $2 billion worth of bonds denominated in US dollars. Such bonds are commonly issued by governments around the world to finance their operations. And while China has sold US dollar bonds before, there are a few reasons why this recent sale drew more attention. Bonds are ways for governments to raise money, but China doesn't need cash urgently. Indeed, it's currently sitting on the world's largest foreign exchange reserves, holding more than $3.3 trillion in forex. By way of comparison, Japan, the world's second largest holder of foreign reserves, has about $1.3 trillion in forex. So I think we can conclude that China doesn't really need to raise more cash. And so this raises an important question. Why then is China selling these bonds? Issuing US dollar bonds serves a few strategic purposes. First, by issuing bonds in US dollars, China provides liquidity to international investors who rely on the US dollar as the global reserve currency. Despite geopolitical tensions, the US dollar remains the backbone of international trade and finance. More broadly, selling bonds demonstrates financial strength and credibility even amid China's slowing economic growth. The success of the sale underscores global confidence in China's economy. And the recent sale clearly demonstrated this confidence. Demand for the Chinese government bonds far outstripped supply, or in more formal terms, the bonds were oversubscribed by nearly 20 times, with a bid-to-cover ratio far exceeding the regular auctions by the U.S. Treasury, where demand usually runs about 2 to 3 times the issuance amount. The even stronger mark of confidence was the bond pricing. The interest rate for a bond can generally be viewed as a proxy for the level of confidence the global economy has in that state. Countries with strong, stable economies typically pay lower rates of interest, usually measured in basis points, than countries with weaker or less stable economies. And credit ratings agencies normally reflect this in their credit grades. Treasury bills issued by the U.S. Treasury, for example, are rated as AAA, the highest score available to any country, while China's U.S. dollar-denominated sovereign bonds historically have been rated at A+, a slightly lower grade. And typically government bonds with an A+ credit grade trade at a premium of 10 to 20 basis points, or 1 to 2% above the price of U.S. Treasury bills, with that higher price reflecting the greater perceived risk of such bonds. And that's where this most recent issuing was so interesting. The Chinese bonds were snapped up at an interest rate of just 1 to 2 basis points, or about 1/100th of 1%, above the price of U.S. Treasuries, effectively trading on par with the U.S. government's own sovereign bonds. The choice of Riyadh, Saudi Arabia, was also interesting. Sovereign bonds are normally issued in traditional finance hubs like London, New York, Shanghai, or Tokyo. But issuing the bonds in Saudi Arabia bypasses these traditional financial hubs and highlights the growing ties between Beijing and Riyadh. It acknowledges Saudi Arabia's growing economic influence and its potential as an emerging financial center. And it deepens the economic partnership between China and Saudi Arabia, potentially paving the way for future collaborative investments. But the Chinese bond sale is much more than just an economic move. It can also be viewed as a political signal to the incoming Trump administration, which has promised a more aggressive approach to U.S.-Chinese trade. By successfully issuing these bonds, China demonstrated its ability to compete directly with U.S. Treasuries as a destination for dollar-denominated investments. And by doing so in Saudi Arabia, it creates a bond market that might offer an alternative to countries that want to reduce reliance on U.S.-controlled financial systems while simultaneously weakening the ability of the United States to control access to dollar-denominated transactions, something that China has been worried about since the U.S. imposition of sanctions and the freezing of Russian financial assets following the outbreak of war in Ukraine. In other words, this move subtly challenges the global status quo of the global dollar ecosystem, introducing an alternative option for countries like Saudi Arabia to park their dollar reserves with Beijing instead of Washington. Such a move could potentially even redirect substantial dollar flows away from the United States and U.S. financial systems, potentially even allowing China to operate as an alternative manager of dollar liquidity in the petrodollar system. Indeed, if China can scale up its dollar-denominated bond sales, and that's admittedly a big if right now, but if China can scale up its dollar-denominated bond sales, it could potentially create a parallel dollar market, undermining the U.S. Treasury's monopoly on global dollar flows while simultaneously protecting China's massive U.S. dollar reserves. This shift would have massive implications for the U.S. economy. If other countries can significantly increase their investments in Chinese dollar bonds, there would be a decline in demand for U.S. government debt, potentially forcing the U.S. government to increase interest rates to attract investors, expanding the debt burden, and carrying negative economic consequences for the domestic U.S. economy. And in the long term, such a shift could gradually even erode the U.S. government's ability to use its financial dominance as a geopolitical tool. The $2 billion issuance might seem modest now, but its implications could reshape the global financial system if scaled up. It could present potentially strategic challenges to the U.S. dollar's longstanding dominance in global markets. And the move signals China's ability to compete directly with U.S. treasuries and could, over time, contribute to a more multipolar global financial system. But what do you think? Could this mark the beginning of a larger shift in the global financial dynamics, or am I just overreacting? Share your thoughts in the comments section below, and if you enjoyed this video, don't forget to like and subscribe for more insights to global politics and economics. Thanks for watching, everyone. Until next time, stay informed and stay curious.